GPT-4 is another hit. Microsoft's AI infrastructure, Samsung goes Capex wild, Applied Materials payday, TSMC's yields are rising, and a quick update on chip exports. All that in today's episode of Semiconductor Investing and More, episode 19. Like always, I'm joined by two amazing co-hosts. First, let me introduce Nick. Good morning, Nick. How's everything on your end?
Doing great, Jose. Sorry, had some technical difficulties today. I'm going to blame daylight savings time. It crashed the hardware. That's got to be it. The calendar, it's like a Y2K issue, except 23 years later.
Definitely, Nick. And also, I'm joined by Billy. Good morning, Billy. How's it going?
Good morning. I'm all for abolishing daylight savings time, just like Jonah Ryan on the show Veep. I don't know if you guys ever watched it.
I just want to say, now that I'm more freelance work and I don't really have a time to wake up, I feel like daylight savings is really kicking my butt, because normally I was forced to get up at the proper time to make it to work. Now I'm like, it's okay if I stay in bed a little longer. Absolutely. All right, guys. So let's start off with topic number one. And I think we're hearing a lot of talks of artificial intelligence. And I know we've talked about it before in this channel. Microsoft, they just finished their Microsoft event as we are recording. Luckily, we started the show about 40-50 minutes later than usual, so I was able to catch it. So I want to get a closer look at some AI updates and what are some companies that can benefit from this. Obviously, we've taken a closer look at the semiconductor companies that can definitely see the opportunity here as they provide the computational power. But I do believe there are some other big players. So first, in this slide, I have a lot of kind of headlines here. First, we see that Google opens up its AI language model, PaLM, to challenge OpenAI's and GPT-3. So I do believe one of the bigger winners here are going to be the cloud server providers, as they give these solutions out to developers and other companies where they're going to come and use Google Cloud or Microsoft clouding solutions or Amazon's clouding solutions, and they're going to start using these AI products to kind of implement into their own application, into their own website. So I do believe that's because these are already consumption-based models. I think cloud server providers are going to be the big winners here. We did see that, for example, AWS, they did a collaboration with Hugging Face, which is another kind of large language model company, to make generative AI more accessible and cost efficient. Again, they have those solutions, but not only are they implementing it themselves, but they're bringing it to kind of an open source world where other developers are going to be like, hey, let me use Google Cloud so I can get access to PaLM and start to implement this into my app. We also saw Microsoft, right, with their clouding solutions. They recently announced the machine series, a virtual machine series to accelerate generative AI. They mentioned that these series are going to be using thousands and thousands of NVIDIA's H100 GPUs. A lot of semiconductor investors were excited about this, but I do want to say it's not necessarily new news. We heard about it, I believe, last earnings, 2 earnings ago, not the most recent, the one previous to that one, where Microsoft announced a huge partnership with Nvidia to kind of do these virtual machines. So this is just the post after that news. This is actually coming to fruition. So we saw Microsoft is releasing new virtual machines for the main purpose of AI workloads. A lot of great other updates. We did see that OpenAI, they did release ChatGPT-4, which is their most advanced system. I think this one's pretty interesting. They don't call this no longer a large language model. They call this a large model. And the reason being is now the input is no longer just text. You can also submit images as input, and the kind of processing, the machine kind of learns from both imaging and text. And to me, that gets me excited as a semiconductor investor, guys, because being able to see the difference between images, in my opinion, is going to need a lot more computational power. So it's going to require more semiconductors. And we are seeing a lot of companies move into this. 2 final points that I also have is here. when they released ChatGPT 4, they did announce a few companies that are already using it or integrating it into their platform. And I feel like this is how the big players are going to win. They're going to, like I mentioned, give these solutions to developers. Duolingo is using it to deepen the conversation on the if you're trying to learn different languages. Stripe is using it to leverage their overall user experience to combat fraud. I believe even, I'm not sure if it's JP Morgan and Chase, I believe, is also using it in some of their products as well. So I do believe the bigger winners here are going to be the cloud server providers as they continue to bring these developments and solutions to other players. So here, just a quick updates here. I'll pass it over to you, Nick. Any thoughts on outside of the cloud server providers and maybe the semiconductors that might be winners here, or just other thoughts here in the AI market?
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
Yeah, this is interesting, Jose. I think it's interesting to see this unfold. The last decade plus, we kind of all went software as a service crazy. Everything got turned into a subscription model. And I've long held maybe not long held, at least for a year, I would say, and we've talked about this, Jose, a number of times, where we kind of generally think AI changes that a bit, right? Cookie cutter SaaS business model doesn't work because AI is going to have to be so customized to each company. You can't just roll out a service and charge the same to everybody based on like how many people are using it, like how many seats are going to be users. So I think this consumption model is going to kind of augment. I'm not saying SaaS is going to go away, but I do think a consumption model is going to grow in importance and kind of augment the subscription model that we've gotten used to. And some of the stuff is going to get really expensive. So I agree with you, Jose. I think the cloud service providers are going to be big winners. And obviously semiconductors, it means more content for them getting stuffed into data centers.
Thank you for that, Nick. And I want to say, I don't follow this company too much, but I did a recent deep dive for Motley Fool show, C3.ai. Very controversial company in forms of where it goes. But most recently, it did change its business model from subscription-based and is kind of focusing now more on consumption-based as this kind of market is shifting. So, Billy, any thoughts here?
Yeah, and sort of the biggest SaaS software company to come along in recent years is Snowflake, which also operates on a consumption-based model. Cloud service providers, and then anyone who provides the horsepower for all this computing they're probably going to do quite well in the next for the rest of this decade. And then it's also a question of like how much can AI sort of supplant human headcount, which can also lead to cost savings, which will also benefit all of the tech tools that are going to be augmenting humans or replacing extra humans you would normally need in a business. Again, I keep turning to Meta Platforms, who, they're cutting another 10,000 people from their organization, and they're saying that, at least Mark Zuckerberg is saying that they're getting more efficient, and the business is actually improving because of that. And what have they been doing for the last year? They've been investing huge amounts in AI. So, tech had a terrible 2022, but I think those at the forefront of this big shift, starting with the release of ChatGPT, I think it was November 30th. It might be in a new AI, the ascent of AI could be leading to a new tech bull market, I think.
Yeah, definitely, Billy. Thank you for that, Nick. I just want to kind of end this topic by saying, I think earlier on, I was fearful that this AI movement was more of a hype, like we saw with the metaverse and like we saw with maybe cryptocurrencies. I feel now that I'm seeing more big tech really kind of start to invest more and more and get deeper into it, it could still be hype, but I believe the probability of it being hype is being reduced as big tech just continues to kind of pile money into it one way or another. So thank you guys for topic number one. I think we are able to move on to topic number two, where Nick kind of goes a little bit more about Microsoft and their AI infrastructure. So Nick, I'll pass it your way.
Yeah, this is a nice segue from what you were just talking about, Jose. And I think maybe before we talk about this Microsoft Azure infrastructure, I might just mention, or maybe I should say piggyback off what you just said, Jose. With AI, it is looking less and less like a hype thing. Chat GPT may end up being hype a couple of years removed from now, but AI itself probably won't be, versus like the metaverse and crypto the last couple of years. And I think the reason is because there's a very clear cut economic, like it makes economic sense. There's a very clear cut business use case where you put AI, be it in the cloud or on premise, to work, and it saves you money or it accelerates production of a project or something like that. Crypto, there's a use case there, but you kind of have to you got to do some digging to figure out what it's going to be, at least at this point. The metaverse, same thing. It might just be too soon. Maybe that's like the 2030s that those things kind of take off. But AI, this infrastructure news is interesting. Like you said, Jose, this is not new news, but Microsoft this week, or I should say this was last week, late last week, Microsoft officially gave a sneak peek of their new AI infrastructure powered by those NVIDIA H100 GPUs. So first slide here, just another picture pulled from NVIDIA's press release, which actually was last year when they announced the H100. But in Microsoft's blog post, there was a key phrase here that I thought was really interesting that I think I'd like to get your guys' thoughts on before the second slide. A Microsoft executive said, when other people come to us and want the same style of infrastructure, we can give it to them because that's the standard way we do it. In reference to this AI infrastructure Microsoft has been building out since partnering with OpenAI and using NVIDIA GPUs to do it. So as most of you viewers probably know, Microsoft has Azure. You can rent computing via their cloud segment, or you can actually buy infrastructure from Microsoft. Microsoft is a huge vendor of hardware. So my question to you guys, my pop question to you guys is, who would be interested in building infrastructure like Microsoft has been building? Tens of thousands of GPUs with NVIDIA. Who would want to do something like this?
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
I mean, the first one that comes to mind, in my opinion, would be in the aerospace and defense world. A lot of these things can't be on the cloud. So they need to bring a lot of this power to the enterprise market, and they still need to keep up with computation. So I would guess, and maybe I'm wrong, but big players like maybe Lockheed Martin, General Dynamics, who want to kind of continue to develop in the AI market, but can't really put that information in things like cloud.
Yeah, well, don't even those companies use cloud too? Maybe because I think there's a pilot. Because the Department of Defense has that contract that they awarded notoriously to Microsoft over Amazon, or now they're splitting it or something. But I think the big cloud companies can do sort of like a ring-fenced cloud
security
for the government. Yeah, I just don't think there's a lot of alternatives for companies that have that amount of financial and technical resources to run these clouds, which is why I like the big the big tech infrastructure stocks so much. Sorry, I know Meta, it has its own data centers, but I don't really see Meta offering services to the U.S. government. And then there's Oracle that's trying to be an up and comer. They actually landed some big cloud contracts with like Uber and stuff, and they're trying to make a go of it as the fourth place cloud provider. Maybe IBM, I don't know, can also try to find its way in there. But it's really Amazon, Microsoft, Google, I think it's going to be hard to be able to invest on the scale that they're going to be able to invest in.
Another one I thought of, I guess part of my question wasn't necessarily building at the same massive scale, but maybe just someone who might want to make use of the infrastructure as it stands. The healthcare industry, which is huge. Like the healthcare industry in the U.S. is it still the largest sector in the U.S.? I mean, it gobbles up like 20% of annual GDP, like $4 trillion a year in spending. And like you mentioned, Jose, with like defense and government, a lot of that stuff, you really don't want it on public cloud. And with like HIPAA rules, it's kind of a similar thing. You don't necessarily want to throw, data, sensitive data up into the public cloud. So I think what Microsoft is kind of alluding to here is basically not just offering Azure public cloud services with AI, but also helping companies build their own private infrastructure to build a hybrid cloud and multi-cloud type of infrastructure for businesses. So you might, a lot of businesses have been doing this already, where they might use like Azure for public cloud on some things, but you might have like some really, really sensitive data that you want to keep ultra protected on lockdown. And so you build your own private data center on premise somewhere. And so Microsoft is now basically saying, I think because of their expertise in building this themselves, breaking new ground with Nvidia, they can now sell this stuff for companies that might want to replicate the infrastructure, albeit on a smaller scale. Interesting comment. Just a second slide here, again from the blog post from Microsoft's announcement of these new H100 power infrastructure. A lot of stuff going on behind the scenes, really over the course of the last couple of years that we didn't necessarily know about until more recently. But this could really just be the tip of the iceberg, linking up these tens of thousands of GPUs just to power one app, ChatGPT from OpenAI. It's kind of mind-boggling to think about, like just, this one application, as big as it is, gobbling up so much infrastructure. And of course, now it's getting plugged in to Azure. So they were kind of prepping for that eventuality, I think, because this partnership dates back to 2019. How many other companies, obviously AWS, Google Cloud, and some other big tech would be interested, but like a lot of other businesses might be interested in doing similar things. I really kind of, the more I read about this, I think it's going to be lumpy, but this growth that we've seen for AI and specifically NVIDIA as like the powerhouse behind it all, we could really just be seeing the tip of the iceberg of this thing. It's massive. We're talking a lot of hardware getting installed.
Definitely, Nick. And I want to say it gets me excited, but at the same time, it sometimes gets me a little bit worried that we're going to see, a huge over inventory correction happening in the next year where all these companies ended up buying all these GPUs. And it's like, hey, I guess we bought a little bit more than we needed. So I'm excited as an NVIDIA shareholder, but I just kind of get flashbacks of obviously like that crypto boom and everything else we've seen with the kind of GPU boom. So crossing my prepping, hoping for the best, but prepping for the worst, I guess. So Nick, any final thoughts here before we move on to topic number 3?
Let's hit topic number 3. It's another spending spree topic.
So for topic number 3, we're going to continue here with Nick, it seems. And we're going to talk a little bit about Samsung and their Capex spree that they're going into right now. So Nick, let's keep it going.
Yeah, the headline that came out on Wednesday was like, wow, Samsung is going hog wild with their Capex plans. But then you kind of read a little bit more, and maybe not so much. But I do still think this is pretty significant news that we should talk about, and I'd like to get your guys' opinion on what this means for investors. But the headline specifically, Samsung, which is South Korea's massive tech giant and just overall largest company, announced that they were going to be spending 300 trillion Korean won. Now, that's 230 billion US dollars, but still a big number, to invest in a mega chip cluster. They're calling it a mega chip cluster, basically outside of Seoul, South Korea. And they're calling it a chip cluster because they're going to build 5 new chip manufacturing facilities, and they want to attract a bunch of other tech companies to Korea. It could be other chip manufacturers, designers, other adjacent manufacturing companies, and they really are trying to double down on South Korea as a tech manufacturing hub. So chips are the big focus, but apparently Samsung, and they're probably going to be getting significant help from the South Korean government. No surprise there, Billy. You talked about that last week.
Mm-hmm.
They're also targeting batteries, electric vehicles. That makes perfect sense. Kia and Hyundai are pretty significant players in the global auto market these days, including in EVs, and also displays, LED and OLED and LCD displays. So doubling down on all this manufacturing, and it seems this is basically in response to the U.S. CHIPS Act. Again, like Billy was talking about last week, Billy, you didn't have to wait very long to be able to say you heard it here first. But it seems like that's exactly what's going on. The U.S. CHIPS Act, $52 billion in various funding plans to get chip manufacturing reshored in the U.S. South Korea saying, you know what, we can play that game too. In fact, we've been doing it for decades already. Samsung getting ready to shell out significant amounts of money to build these chip fabs. So interesting development here in response to the CHIPS Act. What do you guys think? Who wins? I'm not a Samsung shareholder. Zero plans to become one, but obviously with that kind of money sloshing around, there's going to be someone winning.
Chip equipment companies. Again,
can we mention it, Jose?
Can
we mention the chip company?
And I'm going to talk about one in the next section. But
okay.
Yeah, I mean, I agree with Billy, right? Chips equipment companies, I think, are going to be the winners here. But it kind of, even though I don't know how I'm somehow bringing it back to this company, Intel, it kind of worries me for Intel, where Samsung is spending all this money, right? Expected to spend all this money by 24. I forget. It's a multi-decade thing, right? Nick, it's not just right off the bat. I think it's up to 2040.
Yeah, basically over the next 20 years is the plan.
Yeah. And I'm pretty sure they've invested so much money already. And I do have a presentation later on that showcase how this is still, even with all this money invested, still the number 2 player. And very, very small compared to the number 1. So it gets me thinking, like, hey, I mean, sure, Intel has a bit of backing from the United States government right now, but if the number 2 player who's been in this space is spending this kind of money and is still only in the mid-teens market share, how can kind of a brand new starter into it really kind of grow dramatically from here? So it kind of just showcase how, even though it's going to be a very difficult road for companies like Intel or any players that really want to grow in the manufacturing space, it seems.
It's a bit of an arms race, but you also need the execution and the know-how. And we're going to see what's going to happen with this. I think TSMC's founder, Morris Chang, was just interviewed yesterday, and we're not talking about it this week, but maybe we'll talk about it next week. And he supports the policies, but he's also like, I think it's going to make semiconductors more expensive, and the ongoing cost downs we're seeing is going to slow or maybe even reverse. So we're going to have to, maybe we aren't packing more chips into everything every single year. It'll more flatten out. So that's going to be interesting to see if, all of our electronics get a little bit more expensive because of all of this.
Yeah, the chip equipment companies, I really like that bottleneck within the industry where you're going to have some winners and you're going to have some losers everywhere else. But I think the one segment of the industry that kind of gets floated along the way throughout this whole arms race is the chip fab equipment companies. And the two biggest, I think a lot of investors kind of popo the two biggest because it's like, well, they're already huge. How much bigger could they possibly get? As far as revenue, I should say, as far as revenue goes, ASML and Applied Materials are neck and neck. Obviously, ASML is valued much higher, so its market cap is larger. But I think a lot of investors are like, oh, I like the smaller ones because there's more growth potential. And that's true. But if you look at the numbers and you crunch the numbers and do like a cash flow analysis for like the next 5 to 10 years, I don't think there's anything wrong with a forecast for about 18 to 20% earnings growth on average for the next 5 to 10 years.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
I guess that, I think they can. I think these companies can do well. ASML is a little bit different because of EUV, but if you think like the industry is going to grow at mid to high single digits, and then these companies grow a little bit faster than that because of the capital intensity and maybe a little bit of margin expansion and then buybacks, yeah, I could see earnings per share growth being in the mid-teens for a decade. And that's been what the Applied Materials has done that for the last 10 years. Like they've grown free cash. Well, they've actually grown free cash flow at like a 30% rate or something ridiculous over the last 10 years. Now it's a bit more mature, but I could definitely see them maintaining a mid-teens growth rate in earnings for a long time.
Yeah, and that's without a chip boom too over the last decade, right, Billy? I mean, that's obviously the dynamic is a little bit different for the next 10 years, but
yeah.
At any rate, that was like, that's my estimate. I should throw that out there, but like my estimate for on average for these largest players in the chip equipment space, high teens, 20% average growth for, I won't say a decade, maybe I'll say 5 to 10 years though, somewhere in that range.
Definitely, Nick. Thank you, Nick. Thank you, Billy. I think we can now jump into topic number four already. Is it 4? Yes. And I think we're going to move on to a great segue here, a nice semiconductor company in the equipment side that Billy is going to cover. So pass it your way, Billy.
Speaking of Applied Materials, I guess they agree with our assessment, Nick, because they just announced a 23% increase in their dividend in the midst of a global banking crisis. Now I should note it's off a fairly low base, so even with the 23% increase, the dividend's just over 1%. But they've devoted most of their cash flow to repurchases over the years. But they're still also implementing a new repurchase program as well, about $10 billion to supplement the $4.7 billion that they have outstanding. So this is a pretty big show of confidence from Applied Materials, and I think it's the result of, I've talked about Applied Materials, I think each of the last 2 weeks. They had the new Sculpta plasma Sculpta machine that they unveiled, which can enhance EUV. And also they had earnings, which not only are they innovating on the leading edge, but their trailing edge equipment is also booming helping to offset some of the recent weakness in memory and the leading edge. So these guys are very confident. CEO said, this reflects our positive long-term view of the semiconductor market and our confidence in Applied's outsized growth opportunities, technology leadership, broad portfolio, and differentiated products with strong customer engagements. Of note, the last 10 years, the dividend has increased at an 11% compounded rate for 10 years, and the companies were bought back 30% of shares outstanding. So
that's insane.
This is really elite. So that's pretty much like mid-teens total, return. Is a 3% of shares a year, 11% increase in the dividend per year, and just from that alone, you're getting a mid-teens rate. The CFO noted that we're doing this as our business semiconductors diversified, and so it's the diversification that Applied Materials has. Again, we have trailing edge right now, picking up the slack for leading edge. One day, leading edge will come back, maybe end of this year.
Mm-hmm.
And again, he noted the services business has become larger and more subscription based, and that's key because the services business. I think of it like Apple. Apple's sells mostly devices, but it's got like 20% of its revenue in these recurring-ish services, which has helped its margin expansion. Applied Materials has that too. So their services business is usually refurbishments and sort of tied to usage and the installed base. But in recent years, Applied and some of its peers have developed subscription-based services where they use all the data on all their machines for like predictive maintenance and to help their customers increase yields for production. So that's a service that's over 20% of revenue, and I think that those services might have a little bit of a decline this year, but that's entirely due to the China machines essentially going offline. That should grow just about every year with the installed base, even if equipment sales go down one year. As long as the installed base is growing, that should grow every year. And Applied Materials dividend, even with the increase, is like totally covered by the operating income of the services business alone. So dividend looks quite, it's quite safe. It's 1%. But again, these companies just gush cash because they are the capital expenditures. They don't need to spend on their own capital expenditures. They spend on R&D. So they're just in a very fortunate position for this arms race that we're going to see. And their technology is very hard to replicate. And I think their customer engagements are very sticky. You don't want to just adopt a brand new machine from some new company that's coming up from nowhere. It's just more good news I've talked about Applied Materials the last 3 weeks because I always have some new bit of good news coming out. So I just really like this company. Jose got on board already with Applied Materials. You've been talking about it. And just a nice surprise again this week from this company.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
Definitely, Billy. I mean, I want to say from the slide, I there's two things that really stood out to me. First is just the second to last point, where the CFO kind of mentions that they believe their free cash flow will continue to grow over time and can support increasing the yield at an accelerated rate and doubling the previous dividend per share over the next several years. And then that final point where in 2022, Applied Materials made $6.5 billion in net income, and at the same year they made $4.6 billion in free cash flow. So those margins, again, I think originally about a few months ago we were doing where it was just Nick and I, where Billy was still too cool to come with us. Nick showed me this pretty cool chart of just like the the free cash flow margins in forms of revenue, and that to this day, every time I look at it, still surprises me that margin based on that net income.
Yeah, and the margin last year was actually compressed a bit because of the inflation in shipping costs and materials costs in the beginning of the year. So, and the good news is if you have a soft year, like we're probably going to have this year, the free cash flow will probably be closer to net income, or might be even higher, because they had to invest in a lot of inventory last year, which depresses free cash flow relative to net income. But if you slow down, then you don't invest in as much inventory, and that all comes through in cash flow. So even the cash flow is probably going to be more consistent than earnings for this company, which is why they're so confident to dole out more of it to shareholders.
Well, I'm glad that as I exited the last segment, I dropped my 5 to 10 year growth estimate for Applied Materials, and Billy just basically did the calculation for everybody. Napkin, back of a napkin approach. That's it. Like this, the company is awesome. I don't understand. ASML is a cool business, hands down, amazing technology. Probably at this particular point, some of the wildest, craziest manufacturing technology ever developed by humankind. Maybe that's a slight stretch, but if it is, it's not much. But Applied Materials
not
gets
if you've read
overlooked
Chip
all
War.
the time. Yeah. Jose, all right. Jose, you bought Applied Materials. Kudos to you. You got to read Chip War, man.
Yeah, that's next on my list.
there's this passage where they talk about the engineering and challenges to getting EUV developed over 25 years, and it's totally insane, the technology that goes into EUV. Right? It's even more crazy than you think.
It is. It was a bigger undertaking than sending people to the moon. Easily.
That's crazy.
Chris Miller did a fantastic job with that book. But Applied Materials gets overlooked all the time. And I actually replied to a viewer's comment over on my channel earlier today about this. And I think there's this misconception that because ASML is a specialist, it's therefore more technologically advanced. And without a doubt, in some ways that is true, because I just said EUV technology is like the wildest, craziest manufacturing tech ever developed by humankind. In some ways, it is true. It is more advanced than Applied Materials, but let's not take away much from Applied Materials because they're a generalist. They're also very technologically advanced, but their tech is more spread out across a more general field of equipment. But of all the companies in the chip manufacturing space, they have the broadest portfolio. And it's my favorite businesses are companies that figure out a way to combine a hardware business with software, and especially one like this where you have, yes, it's a smaller software component to the business, but you get to sell it basically for free because you just sell it to your installed base. Mm-hmm. The hardware, the equipment's already installed. You don't have to have much of a sales and marketing team to go out and sell the software because you're like, hey, Samsung, we see that you're running 1,000 pieces of our equipment across your global fab footprint. How about this new piece of software we developed to help make that hardware run more efficiently? And Samsung says, sure, okay. Why don't you drop it off to us via the cloud? Like sale done. Highly profitable business, gushing cash. I think, Billy, is a appropriate way of putting it. Love this business. Have owned it for years. It's I think it's safe to say it's my favorite, slightly more than ASML, but that's just me.
And I want to say, just with Billy, he mentioned pretty early on how one of the great things is it's so diversified, and just not only the the leading nodes, but also kind of the more mature ones as well. So if one is lagging, the other one can kind of pick up the pace.
It also helps that it's almost 1/3 the valuation of ASML. So ASML is over 40 times earnings. It's trading at 15 times earnings. So it doesn't have to be as good as ASML.
All right, guys. So I think we're moving on to topic number 5, and I think we're going to stay here with Billy. Billy's going to talk a little bit about the utilization rate for big players like TSMC. So, Billy, sending it your way again.
Me again. So some people might be wondering how the semi stocks are performing so well this year when we might be heading into a recession. We're having these new banking problems pop up seemingly every day now. But I think the big picture is that, semiconductors have been in a recession for 4 quarters already. Like, this started in Q2 of last year, and we're at the end of Q1 2023. PCs had their worst annual decline ever at the end of last year. And smartphones, for good measure, I think were down about 18% at the end of last year. So semiconductors were like the first one into this economic downturn. And now some other parts of the economy look like they might be following suit. But it looks like the semiconductor downturn may be bottoming. And hopefully it's bottoming. And this Digitimes article I came across yesterday basically noted that TSMC's fab utilization. So TSMC, obviously, biggest fab in the world. They make 90% of leading edge chips as well as a bunch of trailing edge chips. Their fab utilization kind of cratered at the end of the 4th quarter and into the 1st quarter. However, Digitimes sees that they're going to start getting sequential growth back to their utilization of their fabs beginning in April, which is a bit earlier than people thought. I think people thought first half bad, continues to be bad, second half recovery. Looks like they're starting to see a bit of a recovery already in the 2nd quarter. So Digitimes, they noted sources from the semiconductor equipment companies. So maybe they were talking to someone at Applied Materials, but TSMC's 7 nanometer and 6 nanometer process, their utilization is now below 40%. So that's not the most advanced node. That was the advanced node, I think, 2 years ago. But they see that bouncing up to almost 50%, which is still low, but certainly an improvement. The 4 nanometer process, which were the most advanced chips last year, they didn't say what the utilization is right now for those, but they see the utilization for that and demand for that increasing to 85%. That's sort of like a normal utilization, I think, at TSMC. It's usually somewhere in the 80s or low 90s would be like healthy. That could be the H100s starting to pick up steam for all this AI stuff we're talking about. And then their 3 nanometer process, which it's at 45 to 50% now, but that's the new process that's coming out this year. So that could be just that they're starting to get yields. They're getting the yields of that process up. Digitimes sees that utilization going from about 45 to 50% now to about 70% in the 2nd quarter. And they see TSMC will have sequential growth in Q2 after Q1. So that's very encouraging. We might be seeing maybe a shorter semiconductor cycle than we've seen in the past. This would be at the shorter end of it if it were the bottom. Now, there could always be a double dip if we have some sort of terrible financial crisis from some of this banking fallout. It doesn't look like it looks like that's contained for now, fingers crossed. But a 4-quarter downturn would be pretty good as far as semiconductor busts go. It was pretty severe over the last 4 quarters, I must say. So hopefully we're bottoming now, and we'll see gradual improvement throughout the next year. But I thought that was encouraging, and it could explain why the chip stocks are performing so well, even amid macro concerns.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
It is very encouraging. On a different semiconductor show, the three of us posited that maybe we weren't going to have a down cycle in chips this time, and of course we did. But it's been an interesting one, right? Like, it hasn't been the entire industry across the board that's in a down cycle. Like, some of the lagging nodes for automotive and industrial, it's been completely fine, still booming, still a chip shortage, like if you're an automaker, for example. But then, of course, like the PC and smartphone side of the business, which has especially impacted memory quite detrimentally. It is a weird cycle. TSMC is kind of right there in the middle of all of it. It hasn't been a super severe downturn for them, but it's been a downturn nonetheless. It's encouraging to see this, though. I think, Billy, you mentioned on that 5/4 nanometer process, that's probably like the Nvidias with the GPUs. The 3 nanometer process picking up steam, if that's true, if it proves to be the case, there's a good chance a lot of that, if not, I've read in some places, all of it is Apple scooping up the most advanced nodes. So that's maybe also good news if you're an Apple shareholder as well. Maybe iPhone sales later, the back half of 2023 with the next gen iPhone release, and also maybe some of the M series chip MacBooks and whatnot. Maybe Apple has a nice little rebound the back half of this year as well.
Yeah. Definitely, Nick. I forget the actual number. I believe like the top 10 customers of TSMC make up over 70. I forget. I know it's in the high. I don't know if it's 70 or over 80% of total revenue. And most of these companies do depend on the consumer side. So I do want to say we're probably talking a lot about kind of this tailwind created by AI and kind of like the data center market. But if TSMC is really seeing growth here, I would have to guess that a majority is mainly from consumer-based products that might be picking up a lot earlier than previously thought. So super excited to hear that about TSMC. Billy, any final thoughts before we move on to next topic?
No, not really. I mean, it's hard for the PC industry to get worse from where it is right now, right? So it's like, and another thing I want to mention is that this could be a little bit helped by China opening back up, and demand for smartphones and PCs coming back to China, even if the global economy is still kind of not so great. Remember, China was locked down from March until December last year.
Definitely, Billy. Thank you for that. Thank you for that, Nick. So now I think we can move on to topic number 6. And topic number 6, I think, is going to be a great segue from this. This is more of just a general Foundry update, taking a closer look at market share from some of the top 10 players. Here we got some great information from TrendForce. Again, I got to say, TrendForce shares so much great information for free, so definitely check it out. They posted this on March 13th, and they mentioned the following. First, they say that, hey, in quarter 4 of 2022, the Foundry's revenue dropped about 4.7% quarter over quarter. Like Billy mentioned, right, there was that slowdown happening. Like Billy mentioned again previously with TSMC, it seems to be more of a general market that, hey, the slide will continue into at least quarter 1 of 2023. But what I really want to take a closer look is at those market shares, right? So TSMC continues to be the number 1 player, And on the top left, I have fourth quarter of 2022. They had about 58.5% of the overall market. And when we look at it a year ago in fourth quarter of 2021, that was down. That was 52.1. So this big leader grabbed even more market share in this year, even though, like we saw, there was a huge decline. I want to say in things like leading edge products, which TSMC is mainly known for. So I'm impressed that TSMC was able to grab that market share, even though we did see that kind of slowdown in the leading market. Number two continues to be Samsung with roughly 15.8% of revenue. That was down from their same time last year, which was 18.3%. So we can see TSMC grabbed a nice amount of market share from Samsung. One of the main reasons, though, is Samsung did lose a big customers like Nvidia and Qualcomm, which kind of shifted. I do believe Nvidia used to make one of their RTX graphics cards from Samsung, but they ended up moving them to TSMC instead. Qualcomm did pretty much the same thing. So unfortunately, Samsung is losing some customers. TSMC, like Billy mentioned, they might have saw a decline in the 7 nanometer, but they are seeing a nice increase offset in the 5 nanometer as companies continue to develop, like the H100. I believe AMD's Genoa is also based on the 5 or 4 nanometer process, and their new graphics cards. I believe Sapphire Rapids, maybe not Intel, but I know AMD for sure. So pretty interesting here to just see number one still being TSMC. The other one that I want to mention is Global Foundries, not one that we talk about. I feel like this is more on trailing edge products. But while most companies kind of lost market share, Global Foundries kind of maintained the same amount, 6.2% in this quarter for 2022 versus 6.1% in the fourth quarter of 2021. So it does seem like all the other foundries tended to lose market share, but Global Foundries was one to at least keep that on their trailing edge products. So that's pretty interesting. And I think this could be another great winner with the overall kind of CHIPS Act, since this mainly is a U.S. based manufacturing company with a lot of plants, I believe, in New York and maybe Texas. I forget where else, but I know they have a nice amount of plants in New York. So, guys, one final thought. I think Billy mentioned this earlier on, but I did see that TSMC's new U.S. fab are expected to dent profits. And this is going to be something hard for them to be able to transfer those increased costs to their customers. So I do want to say maybe TSMC, while they are gaining some revenue and gaining market share, I do believe it's going to come at a cost of some of their margins. And I think investors might understand that, as we've heard that, hey, obviously manufacturing in the United States and probably anywhere outside of most Asian regions is a lot more expensive. And I do believe many investors were already expecting that, but it's just kind of interesting to hear, to continue to see stuff like that. So passing it over to Billy, since he was just talking about the foundry market. Anything here that kind of grabbed your attention, Billy?
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
Global Foundries is a company we should probably talk about more. That's going to be a big beneficiary, I think, of the CHIPS Act. And again, these guys were spun out from AMD. It used to be AMD's fabs. And then they decided not to compete on the leading edge, but to focus on these trailing edge specialty nodes. And that's looking like a really good business decision. They've been showing impressive growth this year. Now, the stock is a little bit expensive. It actually trades like a growth stock. But they don't have to spend the insane sums of money on EUV and everything that TSM and Samsung and Intel have to. So it's encouraging and not a surprise to see them picking up market share. And then you can just see the Chinese companies totally falling out of bed. That's the impact, I think, of the new administration's regulations, and should not be terribly surprising there. Those are just the couple of things that I had mentioned, and not a surprise to see TSMC just dominate and yet continuing to take market share, going from 56.1 to 58.5, just unbelievably impressive. Those are just the three things that stuck out to me.
Yeah, same. Not surprising to see TSMC win more market share. I don't know how much higher that figure will go, but it's not surprising. It's unfortunate for Samsung, but I think they'll be okay. They'll pick up some other customers along the way. There'll be a lot of back and forth. I think the real loser in this list is unfortunately Intel, because they were really kind of hanging their hat on the foundry business, and it looks like things are starting to pick up steam again. And I'm not sure Intel Foundry Services is ready to compete at this level yet. Mm-hmm. So that's unfortunate. Maybe in a few more years down the road, we'll see them pop up on this list. Also agree with Billy on Global Foundries. It's not one I'm interested in owning at this point. I still get really nervous at the valuation, because I do believe at some point auto sales don't need to fall for the chip shortage to come to an end for automakers. There just needs to be more supply that comes online. And when that happens, look out below. It's what happened with the smartphone market this year. It was not just softening consumer demand. It was just supply coming back online. Global Foundries we should talk about more, even though I don't think, Jose, do you own Global Foundries?
No.
Bill, actually, I don't think, Bill, you don't either, do you? Yeah. No. We could probably dedicate some more time to poor Global Foundries, because it's an impressive business. It just makes me nervous at this particular stage, because I felt like for 6 months now that we're kind of approaching the end of the chip cycle for the automotive and industrial market. Hasn't happened yet, but once that cycle starts headed down, Global Foundries is one I would be interested in scooping up on the cheap.
Thank you for that, Nick. And just to kind of end this topic, Billy mentioned it really well, how he saw that we did see a bit of a loss here in market shares for the Chinese players. And I do want to say he mentioned export controls, and that was the kind of segue for the next one, where we do see that recently there have reports that U.S. is set to further tighten chip-making exports to China. We also heard earlier this month, in March 8th, that the Dutch government was to restrict sales of processor chip techs again to China. We also saw reports that China's largest chip makers delays new fab plants, and many believe it's overall due to the sanction controls right now. So pretty interesting here. I think as an ASML investor, we talked... For ASML investors, I'm not an ASML investor, but we talked about how ASML continues to reiterate that, hey, they've already can't send deep ultraviolet machines to China since 2019. So, extreme ultraviolet machines to China since 2019, I believe. The new regulations also will take time to be passed, and companies will need licenses approval to I misspelled it there, to ship specific products to China, and ASML believes there's going to be no real impact will happen to their financials in 2023 or the long term. The big issue here is it does seem like it is already impacting China's technology advancement one way or another. So to close out this episode, guys, any thoughts here on the export controls that we're seeing for chip companies? Maybe not in the political sense, but for chip companies, do you see them lacking a customer, or kind of seeing a reduction of a customer in China being a huge impact? Or do you guys see that, hey, as this manufacturing expansion is happening globally, it's going to be enough to offset that decline there? Nick, I'll pass it to you to just hear your final thoughts before we close out the episode.
I want to thank the Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode.
Yeah, ASML is my close second behind Applied Materials for chip fab equipment. I think it's still full steam ahead for them this year because they had so few sales last year because of supply chain constraints. The EUV news is non-news for shareholders of ASML that have been dealing with this already for a few years. It's a non-issue. It's already gone. That business is already left. So it's full steam ahead for the company this year. They can still sell a lot of other things to China, like the DUV, deep ultraviolet machines. They do have some competition on that front from like Canon in Japan. But yeah, I think this is a green light for ASML. It's okay. I think this was not as bad as some feared when the news surfaced that the Netherlands and the US were going to kind of team up to enforce some new regulations.
Billy, final thoughts before we close out the episode?
Yeah, I mean, this could be, well, like Applied Materials has already seen this. Some of these companies have already seen the headwind from the export controls kick in last quarter, because a lot of them kicked in right at the beginning of October. So it could be a bit of a near-term headwind for company, especially like Lam Research got really hit because advanced memory was added. So China's big memory maker now can't make leading edge memory. And they said they're going to have like a $2.5 billion hit for 2020, this fiscal year. But that's short term. In the long term, as long as demand for chips is there, they're going to be made somewhere. So we're just basically trying to, we're basically shifting some of what was going to be made in China to outside of China. And then we're also denying sales of the most advanced chips to China. So that might maybe around the edges hurt demand. But as long as the long-term growth of semiconductors is there, they're going to have to be made somewhere. We're just in the midst of sort of shifting some of that out of China and then putting it into other friendlier countries. And that'll just take a little bit of time. So long-term picture, I wouldn't worry about it. Near term, it might affect this year's results, but also everybody's sort of aware of that.
Thank you for that, Billy. Thank you for that, Nick. And I think this is the end for episode 19 here at the Semiconductor Investing and More. Hope everybody enjoyed the episode. Like always, make sure to check out Billy and Nick. All the links are down below for where you can find them. And fellows, thank you again for joining me, and hopefully see you again for episode 20. Take care and have a good day.